where is the stock market going for the rest of 2023 and beyond? And is it even worth investing in at this point? Or can you find better returns elsewhere, like in bonds or real estate? Well, our story today, our situation today, did not start today. It started over 3 years ago. And everything that we are experiencing today is a culmination of the events that have taken place over the last 3 years. Our current economic environment, including the stock market, is a reflection and more so the product of a recipe 3 years in the making. We've had an interesting ride since 2020. A pandemic destroyed any sense of normalcy, and it threw our supply chain into chaos. It also caused people to lose their jobs, but it also did some things that most people probably didn't expect. The market did crash, but it was a flash crash with a quick recovery. And then through that pandemic into the start of last year, while everything seemed to be falling apart around us, the market rose and made new highs. Why? Simply put, federal monetary policy. Hey everyone, my name is Derek and I got my degree in finance, so you don't have to. Let's get right into this video. Federal monetary policy is where we need to start when it comes to today's situation and the potential of where the stock market might go tomorrow. And that is because it showed us something and it gave us a serious clue that we can use when trying to predict future stock market environments. And that is that quantitative easing, or simply put, the Fed printing a ton of money, can cause a rise in the stock market regardless of what's falling apart around us. And that is very powerful to know because classic finance teaches us that the stock market is supposed to be a direct reflection of the economy because it is comprised of the companies within it. But the simple fact that the market continued to rise in the face of economic uncertainty at a time when the real people who make up the economy were struggling, that proves that financial theory incorrect. And it proves that the stock market is not the economy, and it can rise or fall separately from the economy. Now, why did the market rise in this situation is a question that is simple to answer. The Fed printed unimaginable amounts of money, and that money has to go somewhere. And the stock market is much more a reflection of supply and demand, or investment versus divestment, or input versus output. If input is greater than output, it doesn't matter what is falling apart around us. Now, why is that important for today? Well, for a couple of reasons. One, the Fed is currently tightening, not easing. And two, because of the debt ceiling crisis, there are certain spending limitations in place. And for the short term, that makes quantitative easing harder, even if the Fed wanted to. But the Fed doesn't want to, because right now the Fed's main goal is controlling inflation. Think of the stock market as collateral damage. The Fed will avoid damaging it whenever possible, but it will not jeopardize its mission of inflation control for it. And just recently, Powell stated that rate hikes are not going anywhere. While there wasn't a rate hike at the most recent meeting, he made it very clear that this is simply a skip, and that we should expect at least 2 more rate hikes in the future. Now, what does that mean? That means that at the very minimum, rates will not be coming down for the rest of 2023. So when it comes to the stock market, we need to understand that there will be no help or boost from the federal government. And as we've seen in the early days of the pandemic, federal quantitative easing is the biggest boost that the stock market can receive. Okay, now let's switch gears for a second and let's talk about other factors affecting the outlook of the stock market. One of the big ones is that the stock market itself is up over 20% from the current lows. Some people are calling that by itself the end of the bear market. I'm not so sure that that means that it's the end of the bear market. I'd personally like to see new highs, but even so, it is a positive sign. Now, let's connect all the dots so we can understand what the f*** I'm even trying to say. Quantitative easing helps the stock market because there is a ton of money, and that money has to go somewhere. A lot of it makes its way directly into the stock market via investment. But some of it also props up the stock market because of discretionary spending. And the latter is what would plummet in the case of a recession, which some say we are already in. When people lose their jobs or generally have less money, discretionary spending goes down, which means companies make less money, which means their stock prices eventually fall as well. Here's the other problem. Inflation is still high, and Powell confirmed that himself by promising future rate hikes. So if we enter a recession, or we're already in one, and inflation remains high, less people will have jobs, and those that do will still have less money than usual because inflation is high. So if we stopped right here, it seems like the market is in for more pain. But are there positives as well? So let's flip the switch again and look at the positive signs. Wages are going up, and the fight against inflation is definitely working. So I suppose the question is this: will inflation come down low enough to levels deemed acceptable, like around 2 to 3% soon enough for the Fed to finally be able to reverse course? That is the million-dollar question. Now, I don't see us returning to an environment of basically free money and a ton of money printing, but if you asked me point blank where my stance is, I'd be hard-pressed to say anything other than this. I think that the market has put in its lows, and honestly, I think that inflation will continue heading in the right direction, which is down. And I think that 2023 will see the last of major inflation. And in turn, I think that the market will start trickling up steadily in 2024. But then again, I am an optimist at heart, and there are still some very smart people calling for doom and gloom. And there are big-time economists sounding warning alarms for a major recession. But the way I see it, as long as we can avoid a major recession, and as long as inflation keeps heading in the right direction, my bet is that the worst, at least in regards to the stock market, is behind us. Now, this opinion is a fluid one based on the data as it comes in. So it can change literally tomorrow. And it will change as data comes in and as time keeps trucking forward. And we will see if this video ages well or poorly. Regardless, my goal here is to simplify financial topics and to talk about personal finance because it is what I truly love. And I also love being able to share that with all of you. So if you like personal finance and good discussions and analytical breakdowns of the economic world, then I think you'd love the channel. So feel free to subscribe if you haven't already, and make sure to turn on the bell notification so you don't miss the next video. Again, my name is Derek and I got my degree in finance, so you don't have to. I hope this video was informative, enlightening, and kind of gave you perspective into what the stock market is doing in the current environment. I'll continue to provide you with updates as I continue to dive deep into the data, and I will see you in the next video.